Hi, I'm Dr. Cheryl Dunn, and I'm here to talk about analyzing fixed assets on a company's balance sheet. There are three ratios that are typically used to analyze fixed assets on a company's balance sheet. The first is called the average life. The second is called the average age. And the third is called the asset turnover. Now the first two work best when the company uses straight line depreciation, and I think you'll see why once you look at the formulas for those. Okay, so let's look at the average life. The average life is going to be calculated as our property, plant, and equipment, which is fondly referred to as PP&E. So we're going to take that property, plant, and equipment, and we're going to divide it by the depreciation expense for the year. So for example, if a company had $1 million worth of property, plant, and equipment, and they had depreciation expense for the year of $200,000, that would mean they have, on average, a 5-year life for their assets. Now again, that's going to be a lot more representative if that depreciation expense is even throughout the life of the assets. And so you can kind of see that. The average age, we're going to take the accumulated depreciation and we're going to divide that by the depreciation expense. And so, for example, if this company had accumulated depreciation of $800,000 and its depreciation expense was $200,000, then you know that the average age of the assets is 4 years. And if you combine that information, they're 4 years old and they have a 5-year life, that tells you in the next year they're going to be completely using up their property, plant, and equipment, and so they're going to have a big expenditure coming up to replace those assets. And so that's where those two calculations together come in pretty handy. For the asset turnover is calculated as the net sales divided by the average PP&E. So we take the net sales for the accounting period and we divide it by the average of the PP&E, the beginning and the ending year balances. So for this company, let's say that $1 million was an average. And of course, if they don't give you the beginning and ending and they just give you a single value, that's all you can use. And let's say that their net sales were $400,000. That would give you an asset turnover ratio of 0.4. That would give you an indication of how productively the company is using its fixed assets. If for every dollar of fixed assets they're creating 40 cents basically worth of additional revenues. Whether that's good or not depends on what industry they're in, and you'll also want to compare it to prior year's performance. So I can't tell you 0.4 is good or 0.4 is bad because it depends what industry the company is in, and it depends also on what they've been doing over time.